Are you prepared for the $100,000 a year long-term care costs in your retirement years? Well, few are. There are, of course, options such as long-term care insurance, but many are scared away by the high premiums. Christine Benz, she's the Director of Personal Finance for Morningstar, has some suggestions on how to make it work. Now, Christine, a lot of people, I think, are simply in denial about what these costs are going to be later in life.
Well, people are in denial because it's not a happy subject. People don't like to think of themselves disabled, incapacitated, unable to make some of these basic decisions for themselves and unable to carry out the basic activities of daily living.
Once they think about it, then it's suddenly so expensive. But you say, depending on your age, it may be best to procrastinate?
And that's a rare answer when it comes to matters of personal finance. But one of the reasons that long-term care costs are so high right now is that interest rates are so low. So the insurer takes in your premium and it knows that it can't earn a very high safe return on people's money. So the premiums have gone up and up. I think that the worst is probably over. When interest rates in fact go up, that we could in fact see perhaps pricing on these policies become a little more affordable. So if you are at the younger end of the long-term care purchasing spectrum, so maybe you're in your early to mid 50s, you could in fact delay the purchase and perhaps obtain more advantageous pricing down the line.
You also say to skinny down in the type of coverage you get. What do you mean by that?
Well, oftentimes if you meet with an insurance broker, they'll kind of sell you gold-plated coverage that will cover you for an unlimited period of time, that will start from the moment you need the care. The insurance will kick in. But if you're willing to forego some of those bells and whistles, maybe look at a policy that covers you for a finite period, say a couple of years, maybe if you're willing to pay out of pocket for a while before the insurance starts paying for you, maybe if you're willing to settle for a lower inflation adjustment, you may be able to get a more affordable policy to buy yourself a baseline of coverage.
Ask questions when you're applying.
Absolutely.
And then you say health savings accounts can be a good option here.
For people who have decided to forego insurance, who say, well, I'm just going to pay out of pocket long-term care costs as I incur them, a good way to think about doing that is to save within a health savings account, because you received several tax benefits. You can put pre-tax contributions in, the money grows on a tax-free basis, and assuming you pull out the money for qualified health care costs, those withdrawals are tax-free. So you have a lot of tax incentives to save within one of those accounts.
Good ideas all. Christine Benz from Morningstar. Thanks so much.
Thanks, Bill.